Good morning, folks, and welcome back to Almus Market Mornings. Well, the Federal Reserve's interest rate decision is out, and they have cut rates by 25 basis points. While we get into the details, what I found interesting was the largely unanimous support for the decision. Except for the newly inducted governor, Stephen Miran, everyone else supported a 25 basis point cut. The key now becomes what was shown in the summary of economic projections, because on a market reaction front, things are all over the place. The dollar index initially hit new cycle lows, only then to smartly recover. Even gold is seeing some profit-taking moves. Good morning, JK. How will you rate this meeting? Was it a disappointment for the markets, or we just about met the expectations and these are just profit-taking moves? What's your thought?
Good morning, Swaraj. I think to say it in a very short statement, the policy was par for the course. But let us look at it from three perspectives. Um the headline, 0.25% cut, not a surprise. Dissent from Mr. Miran, who wanted 0.5% cut, that's not a surprise. Fed statement mentioned the risks to employment having risen and attentive to both sides of the dual mandate, that is inflation and the full employment. Now, if you look at the dot plot, that gets very interesting. Two cuts in 2025, that was again as per market expectation, but only one each in 26 and 27, with target neutral rate at 3% expected to come only in 2027. That was a slight disappointment for the market. So to that extent, it was left dovish. Powell did not fail to mention his standard line that it was not a plan by the Fed to uh, follow that path of rate cuts, but it was only a member's view that is being plotted. Now, another surprise in this, summary of economic projections is GDP being projected 0.2% higher for both 2025 and 26. Even as market has been expecting economy to sharply slow down. On inflation front, they see 3% being maintained, up forecast for 26 by 0.2%. But Fed target of 2% is not going to be reached until 2027. So again, this can be read as a slightly hawkish projection as far as inflation is concerned. They actually expect unemployment rate to ease every year steadily. And now this is not showing the big deterioration that most are expecting. Now the final part, the Powell pressure. Powell characterized the day's policy action as a risk management cut in response to the weakening labor market. But he is not saying, he said that the central bank is not needed to rush easing. Now, he was not as upbeat about the economy as in the previous meeting, but he was not too pessimistic as well. So the way import prices are being absorbed by the uh, domestic companies is something that he's going to watch in the coming days. Now, inflation was still elevated, and overall effect of tariff on inflation remains to be seen. Risk of persistent inflation from tariffs need to be managed and assessed. So all these are somewhat cautious statements. Does not ensure that Fed will be on a steady easing path. Now, unless the job gains are going to come down even more drastically, while they are now currently below break-even rate. But he's also pointing to special factors like immigration affecting the job market. So overall, he says a change in balance of risk suggests that they should be moving in direction of neutral rate, but no major support for 50 basis point cut in the meeting yesterday. So my view on the whole, decision and Powell's statements is that economy is still evolving on slightly on the weaker side. Fed has probably done what is right and keeps its option open based on hard data. It's aware of the dual risk. It does create a sense of confidence in the central bank's credible approach. Now, they have not been, if they had cut by 50 basis points, probably it would have been seen negative again, because then they would say they were yielding to political pressure. So this is a very a credible point in favor of Fed. Now, if you look at the markets, yields rose after initial dip, small dip. That shows how the market had discounted the Fed move of 0.25%. Now, the best way forward for the market is to see how things evolve in the economy. assess whether Fed needs to do more in short term for the rate cuts, and if so, how much, and most importantly, whether trajectory of inflation suddenly takes a surge if intermediaries are not able to absorb the price increases. So I think we need to watch more of the upcoming data on both the inflation and job market to assess whether if it gets more dovish and faster rate cuts will become. So that is the key point from where the market reacted. So I think if you look at the bond market, both the 10-year and the 2-year actually jumped after the decision. One could say they had already fallen in anticipation of the rate cut. In recent times, we had also heard about 50 basis points being projected by some of the leading bankers as well. So to that extent, market has reversed the excess expectations from their portfolios. Now, if you look at the stock market, of course, I would say it was a very neutral performance, and I think it could have been a performance on any day other than Fed meeting as well. So nothing to read from the stock market. From dollar, of course, it hit a new low, of below 96, closer to 96, but bounced strongly. Now it is trading above 97, and euro hit a new high above 1.19, could not sustain. It's back closer to 1.18 now. Again, the latest moves down in the dollar had come even before the Fed meeting because of the market talk that Fed could go for a hefty cut of 0.5%. So that has been taken back by the market. It's more sedate move that will come. Not saying that dollar is going to rally. Market is going to look for fresh factors or triggers, for taking a further view on the dollar. So if you look at the dollar in a technical basis also, at 96 or around that, we have a significant long-term trend line support. That's the reason why market is not aggressively selling the dollar at that level. We really need some very big negative trigger going forward. So that is why I'm saying we should watch the upcoming data on the economy, particularly in the upcoming PC inflation in the coming weeks, and also the employment report of September. So these are important for the market. So overall take, again, to repeat, a par for the course, but market will be on the verge. No significant reaction should be expected in the coming session unless there is a new trigger from the economy in the US. Of course, we also had a rate decision from Canada. They cut 0.25% to 2.5% policy rate, pointing to risks on the economy, less concerned about the inflationary pressures as well. We also have Bank of England meeting today later, and they're expected to hold rates steady. Now, domestic market, two big moves. One in the rupee. We had seen yesterday a fall of almost 25 paisa from the previous day on the USD INR. Now, while the previous day's move was driven by some flow, yesterday's move, I would put it to long liquidation on fears that the Fed might cut larger and the dollar index could fall much more. So that was a reaction. But in natural buyers were present below 87.80. And even after the Fed meeting, when the dollar index fell to new low, dollar P touched just under 87.70, but it's since bounced back and it is trading above 87.90. So the dollar rupees performance is more linked to the issue of trade and tariff with the US, where market is still watching out for progress despite the recent warm-up messages that has been exchanged between the Indian PM and the US president. So they probably set an atmosphere where discussions could proceed, but no hard or no real progress has been seen or declared so far. That's why the market would remain cautious about selling the USD asset. On the other side, the stock market continues to gain. I think the underperformance of last several months is getting reversed. So that probably is one positive factor. it's not yet turning into a reversal in the FI flows to the positive side. But yes, I think at least it is keeping the sentiment slightly positive. I think, as I said earlier, we'll continue to watch the US economic numbers and the progress on India-US trade talks. Today, we'll have the jobless claims number. Last week, we had seen a hefty rise of 27,000. That needs to be watched whether that trend continues, and if there is another big jump, then probably we could see dollar index getting the push down. Otherwise, it can continue to remain in the range. Apart from that, we don't have too much of data, too much of significant data today. We'll be on the central bank watch for Bank of England decision today evening and Bank of Japan meeting tomorrow. Thank you.
Thank you, Jack. And just quickly summarizing, when it comes to the Fed meeting, it seems after the meeting, the excess expectations on rate cuts, that's the things getting reversed. We are broadly on the markets front. JK, we are broadly at the levels seen before the Fed meeting, right? We are trading around
Almost.
Yeah.
Yeah.
So that's where we are at when it comes to the market moves. The dot plots show one more rate cut for 26 and 27, while two more rate cuts this year. Slightly higher GDP production, but also from the inflation side, they are cautious because the 2% target is expected to be reached by 2027. They are cognizant of the tariff-related inflation pressures seeping into the economy. Powell positioned this cut as a risk management move rather than opening up further for the being too dovish or too sort of on the easing front. He is not in a rush to bring down rates very quickly. They are still watching out how the economy evolves. The dollar index hit new cycle lows, but it bounced back strongly again to levels seen before the FOMC. On the Indian front, we saw Rupee strengthen significantly yesterday by 25 paise. But since then, it has again come back above 87.80. Dollar buyers were present below 87.80. So USD INR is more linked to the issue of trade and tariff rather than how people are positioned for the FOMC. That's it from us today. Thanks for listening. We'll catch up tomorrow with the fresh round of updates.